I just spent way too long on the IRS website to make sure that not only what we're going to talk about today is 100% correct, but way easier to understand than all the jargon that they put to talk about it on irs.gov. But what we're going to be talking about today is cash versus accrual-based accounting. If you've been watching a few of my recent videos, you've heard me reference this, and I've had a lot of people actually ask me to make this video explaining what it is. Because even though I recommend that you should use a tax professional at the end of the year, like a CPA, to make sure that everything is in order when you're filing your taxes, if you're a small business owner and you don't have a lot of money sitting around, you might have to do your bookkeeping yourself, which is what I do. And understanding this concept can help you understand not only how much money your business has right now in terms of cash flow, but also what your business might be worth. I know that some people already don't want to be hearing about this because taxes and accounting is really freaking boring unless you're a nerd like me. So real quick location check, and the reason why there's no sheets on my bed back there is because we're at a laundromat today. Chris is inside getting a lot of our laundry finished up, and we just made it into Texas, and we'll be here for probably about a week or two, depending on how long we're staying in cities, and then Big Bend National Park. But less than 2 weeks ago, we were in Chattanooga, Tennessee, then Southern Illinois, then Kansas City, then Oklahoma City. Now we're in Texas. We've been doing a lot of travel in our van, but let's get back to the accounting stuff. The reason that I feel that this video is so important is because when I was researching for it, I would just look up cash versus accrual accounting, and almost everything on the first page of Google says that you should use accrual-based accounting, and then their numbers for it aren't even accurate to what irs.gov says, which was very weird. Most large businesses, actually all large businesses, use accrual-based accounting, and I'll explain what that is, but I don't think that that's honestly the best for me or you who are just trying to understand how to start a business and run it and get it up to a point where it can not only provide for us, but become something that is pretty big. And if you're new to my channel, I do Amazon FBA reselling, so I do have an inventory, and if you look up how you should do your accounting if you have inventory, everybody says that you need to do the accrual method, but there are exceptions that I think you should take advantage of to do cash-based accounting, and let me explain why, using 3 examples from my own businesses, as well as just helping you to understand what cash versus accrual is. Now, first off, the reason that this is even something that you should think about is because you have to decide what accounting method you're going to use when you file your taxes with the IRS. Not only for your business, but also for you personally, and you probably, without even knowing it, already use cash-based accounting when you file your taxes using a W-2 or 1099s for just your normal tax return at the end of every year. But if you're starting a business and having to file your taxes for the first time this year for that business, you have to decide what method of accounting you're using: cash, accrual, a hybrid method, or there's some other specific ones for like farmers or other very specific professions. Personally, I did this for the first time last year, and I chose the cash-based method even though I was holding an inventory in my Amazon account, and we'll get to that here in a second. I'm gonna need to get a new board. So really quickly, let's go over the basics of cash versus accrual-based accounting, and I should let you know, I'm not a tax professional, but I don't necessarily think this is tax advice, it's more accounting advice, but definitely always go to tax pros with your tax questions, especially about specific stuff. But with that disclaimer out of the way, let's get to it. The main difference between cash and accrual-based accounting is when you track your income and expenses. With cash-based accounting, you track your income when you receive the cash, meaning that an invoice was paid. And I'm going to give a couple examples of this based on my YouTube channel, my Amazon business, and my wife's business. But that's pretty intuitive because at that point you have the cash. So whenever you get the cash, you track it as income. And whenever cash leaves your account, you track it as expenses. So it's tracked when you spend money on a card or with cash, it leaves your bank account, or you put it on the credit card, and there's actually a transaction on your bank or credit card statement. Or cash, I guess, if you use cash, but I never use cash. Accrual-based accounting is a little bit more confusing from the jump. It does make sense, but if you haven't really thought about accounting before or cash flow in any significant way, this might take an extra second to get used to. Which is one of the reasons I don't necessarily recommend it for everybody at the beginning, because you don't need to do it and it's a little bit more complicated. But there are some benefits to it, and we'll get to that. If you've ever worked for a bigger organization, like when I used to work at Enterprise Rent-A-Car, we would have something called accounts receivable, and we didn't really worry about accounts payable. That was more in the accounting department, but that's all based on accrual accounting, because your income in accrual accounting is tracked when your work is done. So when you send out an invoice, you're going to track that as income in your accounting software. Now, personally, I use QuickBooks, and we do have a way to send invoices, and we still do that for our business, but I don't count the income until that invoice has been paid, because we do cash-based accounting. If we did accrual-based accounting, we would have that receivable because it's technically still an asset. That is money that I should earn. So you count that as income when you send your invoice. For expenses, those are tracked when you incur an expense. I know this sounds a little confusing because you're like, hey, when I paid for something, that expense is incurred. And that's where expenses in accrual and cash-based accounting are the same. Like, if you go to a store and you buy something for your business, on your credit card, cash leaves your account and you incur an expense. The difference is if there are any invoices that you receive, which means you have accounts payable. This normally is for bigger businesses, but in just thinking in my world, if someone has an Amazon FBA account and they work with different distributors, there might be times when distributors send them inventory and they have to pay it on a net 30 basis or a net 60 basis. They would receive the inventory and they wouldn't need to pay it for 30 or 60 days. And in accrual-based accounting, you would incur that expense at the point that you receive the inventory because you have a receivable that you're going to have to pay. But in cash-based accounting, you wouldn't incur that expense yet. But for most small businesses, you don't have to worry about stuff like that. So let me give you some pros and cons of cash versus accrual-based accounting before we get into the specific example so that you can understand this better. The main pro of cash-based accounting is that you get accurate cash flow statements. Because when you run your profit and loss statement, it's going to essentially just be a cash flow statement because it only tracks cash that's come into the account and cash that's gone out of the account. But at any given point, you'll know how much cash you have, which is normally more important when you're starting a business, because even if you're doing everything on credit cards, you need to know how much you need to pay off, how much money you have to pay everything off. But the problem with that can also be your profit and loss statement might not be fully accurate, as you can have unmatched expenses and income. But this can be very bad because you might forget to pay an invoice and it might show that you have a decent amount of cash, but in reality you have to pay that invoice soon. So your profit and loss statement isn't fully accurate because that is an expense that you will have to incur that you already know about and is technically a liability on your books. Quick coffee break because that's a lot of information to take in. And that's one of the reasons why I prefer cash-based accounting when I'm not dealing with a lot of invoices, and which is why if I ever have anything that's invoiced, I'll just pay it immediately because I don't want to have to worry about that because I do cash-based accounting. With accrual-based accounting, your profit and loss is accurate, which is a good thing. So you'll always know how much money you've actually earned because your expenses and your income are matched to one another, and I'll tell you more about that when we get into the examples. But you do need a separate cash flow statement, which isn't the best because, like I said, at the beginning of your business, you want to know how much cash you have. Cash is king, and not knowing how much cash you have can be really hard, and then having to do a whole separate statement for that when you could have just done cash-based accounting at the beginning if you don't have a lot of invoices to worry about might save you a lot of trouble. I should tell you though, and this is something that I might have maybe missed to say at the beginning of the video, there are restrictions on who can actually do cash-based accounting. Not everybody can because it is a lot easier as a small business, but it allows for things that are kind of wonky that we'll get to when we talk about my inventory. But if you fit any of these three categories, you have to do accrual-based accounting, and this is most businesses in the world, at least bigger businesses, which is why I didn't talk about it at the beginning because it probably doesn't affect you if you're watching this channel. And we're on that super fun IRS website. It says the following entities cannot use the cash method, and the first one is a corporation other than an S corporation with average annual gross receipts exceeding $25 million indexed for inflation. Meaning that if your revenue over the past 3 years has an average $25 million, so $75 million total, you don't need to worry about doing accrual accounting. You can still do cash accounting if you fit the other two as well. You also can't be a tax shelter. And then the big one that got me scared, which nobody talks about the exceptions of when you're looking at cash versus accrual-based accounting, is this, which is pretty scary. Right under cash method, it says, generally, if you produce, purchase, or sell merchandise, you must keep an inventory and use an accrual method for sales and purchases of merchandise. And that's not good because the accrual method is a lot more complicated to have to deal with and worry about, as we'll see when we talk specifically about inventory in the Amazon business. Because if you have an inventory or you sell something, materials technically count as inventory, like the raw goods that go into it. If you have to do accrual-based accounting on that, you'll have to calculate. I won't get into that now. We'll get into that when we talk about the examples. Just know it's so much more complicated than using the cash method of accounting. But if you scroll down a lot more on the IRS website, we come to this beauty of a paragraph. Exception for small business taxpayers. If you are a small business taxpayer, defined below, you can choose not to keep an inventory. But you must still use a method of accounting for inventory that clearly reflects income. If you choose not to keep an inventory, you will not be treated as failing to clearly reflect income if your method of accounting for inventory treats inventory as non-incidental material or supplies, or conforms to the financial accounting treatment of them, blah, 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 blah. And then the small business taxpayer are people who have annual gross receipts of $25 million or less and are not a tax shelter. So, all that goodness to say, if you're not making $75 million in gross sales over the past 3 years, you can still use the cash-based accounting method even with an inventory. And just so you know that that is possible, that's what I did last year, even though I was carrying over inventory in my Amazon business, because I don't technically have an inventory according to cash-based accounting. So, let's get to these three different examples. So the first example, as I think about it a lot, I don't think will change much between cash versus accrual-based accounting. And this is an income example. Every day I earn ad revenue on YouTube, and at the end of the month, YouTube finalizes it and deposits it into my AdSense account around the 5th to 12th. I get paid on the 21st of the month. And so when we would reflect that income for both of cash and accrual-based accounting would be in the same month. Because even though I'm earning ad revenue every single day, I don't actually get that money because YouTube has to finalize it at the end of the month. Because it's not finalized revenue, it's estimated revenue. And since I don't have the promise of getting it paid out, I technically wouldn't count that as income. My question actually, and you guys might be able to answer this, is would I count this as the 5th to the 12th or the 21st? I think it's the 5th to the 12th because technically the AdSense account is my account. I'm the owner of that account, even though Google has a lot of control over it. And so I'm pretty sure whenever I get paid that into my AdSense account, I get it and then I just have to wait on the transfer. But I would also understand if it was the 21st that I would count the actual income. Here's the tricky part though. Let's talk about an expense that I incurred on YouTube. So I bought a music subscription, which I don't actually use much anymore. I bought the annual subscription and I paid $180 because it was cheaper than paying month to month. And I paid that January 15th of 2021 for 14-month subscription because you get 2 free months. So technically we could just call this a 12-month subscription because those 2 free months might change something, but essentially I got a 12-month subscription for $180, which is $15 per month. In cash-based accounting, I would take a $180 expense in January of 2021. That's because the cash left my account in January of 2021. The problem with that is I didn't just use this subscription in January, or I shouldn't have just used it in January. It's for a whole year, and so accrual-based accounting takes that into account, and you have to capitalize it is the term. You capitalize it over 1 year because that's the useful period of the subscription, and so I would take $15 expense every month. So in January, I would take a $15 expense, in February, a $15 expense, March, $15 expense, all the way through until the end of the subscription. Instead of taking the $180 up front, that would be capitalized over a 1-year period because that's the useful lifetime of this expense. Pretty confusing. That's why I prefer cash-based accounting, but let's get into the second thing, which is my wife's business. We have some similar annual expenses in that business, but we'll just talk about an income here that she has. So in Chris's business, every month we send an invoice around the 5th of the month for payment due on the 20th. For cash-based accounting, since we do always get paid on the 20th, we would take that income and we would count it on the 20th because that's when we actually got paid. Accrual-based accounting is a little bit different, and we would take that income on the 5th whenever the invoice is sent because that's money that we are expecting to receive. So we would take that income as 15 days sooner. But the problem with that is if they never pay us, then we have that income and we'll have to write it off as bad debt, which is a messy process that no one likes. I don't think you could do that in cash-based accounting though, so that's one thing to take into account. Correct me if I'm wrong. I'm not a tax pro. And the last thing that we're going to talk about is the most confusing, at least off the bat, and that is understanding cost of goods sold and inventory. And if you're watching my channel because you're interested in Amazon FBA, this is something that pertains to you and the reason why I think cash-based accounting makes our lives a lot easier. So this is what we're looking at. On Amazon FBA, in December of 2021, I spend $1,000 on inventory. It gets to Amazon and sells $100 worth of my spend in December, not $100 of sales, but out of the $1,000, $100 worth of products that I bought sold, so probably for around $400 or $500, and that sells in December. $500 worth of it sells in January because it takes a while to actually get available on Amazon. $300 worth in February, and the last $100 doesn't actually sell and we have to remove it for disposal. So, cash versus accrual-based accounting, when do we account for the expense of cost of goods sold? And that's kind of the tricky part and the reason why I think that cash-based accounting is so much nicer, at least at the beginning, than accrual-based accounting, even though your return on investment doesn't reflect accurately. In cash-based accounting, we would take that $1,000 expense all in December because that's when the money actually left our credit card or our bank account, however we decided to pay for that inventory. And so all of that is there, which means that we had $0 of expenses in January, February, and March, which is not good because if we just say that everything that sells out of this $1,000 is going to give us 50% return on investment, if $500 worth of it sold in January, there would be a $250 income that's unmatched. And so it would say that our return on investment is infinite because for that $250, essentially we spent $0 because we already calculated all of that back in December, especially because this is over new tax years because I do my taxes based on the actual year. So my tax year will end in December. All of the stuff that's going to sell that I've already sent into Amazon will technically have a $0 expense, meaning that my write-offs for 1 year can be way more than they maybe should be in the new year, even though that's technically legal via the IRS. And I'm comfortable doing that. I don't mind because the business is going to continue to revolve. But that is one thing to worry about because technically the ROI is 0, which is why the reason that you ever hear me talking about ROI, like in the video where I talked about my income from December, it's actually based on the accrual method of accounting because in cash accounting normally it's going to be really off base because it accounts for the cash flow that you have in your business, not necessarily an accurate profit and loss based on cost of goods sold, which I'm okay with. Hey, Editing Anthony here. I just realized some of the numbers that I gave you are broadly accurate, but kind of not. And let's take a quick breather because there are a lot of numbers here. There's a few more coming. We're almost done. Don't worry. But the thing that I forgot about is because in cash-based accounting, we account for all of our expenses in December. That $250 in January isn't actually what our profit is in January. Our profit is $750 because we've already accounted for all of the cost, meaning that our cost is zero. So when we sell that $500 worth of product, the profit that we reflect in cash-based accounting is the cost of goods sold plus what your actual profit is after the cost of goods sold. Because we've already written off all the expenses, which is why it's not as accurate as an accrual-based accounting if you're trying to get the most accurate profit and loss statement to what was actually sold in a month. I know it's probably a bit confusing off the bat, but let's dive into what the accrual method does. The difference is in accrual accounting, you take your cost of goods sold when the goods are actually sold, which is why it's called cost of goods sold, because it's the cost of the goods when they're actually sold. So in accrual-based accounting, I would take $100 in December as an expense, $500 in January, in February I take $300, and then March and beyond, I would write off $100 whenever I dispose of that inventory, and that's why you hear sometimes people talk about taking it as a tax write-off when they dispose of inventory, which you technically can't do when you do cash-based accounting because you've already taken that as an expense. Look, I know this is super confusing if you haven't heard about it before, and ultimately this is why I think cash-based accounting is a lot easier because you have to worry about money in and money out. But when you get to be a lot bigger, you're not allowed to do it, and it's a lot more accurate in your business to do an accrual-based accounting method, but it takes a lot more work to do that type of accounting, which is why I'm not planning on changing to that until I'm a lot bigger and I can actually hire out the accounting that I need to do, because it would take a lot more of my energy to figure out what the actual cost of the goods that I sold in a single month were, versus just saying, hey, I'm just going to write it all off already, and I don't care if it says that everything is 100% profit for this next year because I've already bought the inventory in 2021. So that's why I think cash-based accounting is the easy way to do it, and the way that as a small business person you should be thinking about your accounting, even though when you're thinking about return on investment you're going to have to do some accrual work. But understanding these things will help you to be a much better small business owner, because ultimately the thing that makes your business succeed or fail is how you can handle your money. You can make all the money in the world, but if you don't know how to handle it, you're going to still have nothing at the end of the day. A couple videos that I talk about cash versus accrual based accounting are this one where I go over my December income, as well as this one where I go over what it actually means to be a six-figure Amazon seller. And if you go and watch those videos or rewatch them, you'll have a better idea of some of the things that I'm talking about. If you have any questions about this, definitely let me know and I can make follow-up videos or shorts or something. And I am going to be doing a lot more accounting videos showing you how I do my accounting specifically, but this is the basis of all of it. Thanks for sticking around. If you're still here, you're a trooper.